So today I have with me Jim Webster. Jim, thanks for spending a little bit of time with me this afternoon. And I think more than anything, I just wanted to take this moment. Obviously, we have a lot of doctors out there, and they are entirely skilled for something completely different than financing. I mean, obviously, I wouldn't know what to do if I stepped into their office and obviously asked them plenty of questions. But that kind of, when it comes to this skill set and finance and kind of how these doctor loans work, a little of that is kind of lost in translation. So the purpose of this interview is more or less to kind of smooth out some of the jargon, explain exactly how these things work, and really kind of give us a good overall feel of what this thing is in layman's terms, so that these guys know exactly kind of how these things will work and how it benefits them more than anything, and the reason why these loans exist. And so I think overall, my name is Mike Zimov. Again, this is Jim Webster. Jim, kind of tell me a little bit about yourself, how long you've been working with doctors, and then we'll kind of dive into your loan program after that.
Okay, great. I appreciate it. Thank you. So my name is Jim Webster. I'm a mortgage banker at Fulton Mortgage Company, and we are a regional bank in Lancaster, Pennsylvania. I focus working with medical professionals. Our program is called the Medical Professional Loan Program. It's offered to doctors, dentists, pharmacists, and veterinarians currently.
Okay. That's kind of unique right in there. I mean, not a lot of doctor loan programs offer it to vets as well, which they should, but they don't. So at what point does, I mean, is pretty much the same loan program that a regular physician gets that's available to doctors or to vets as well?
Yes. So, and also the pharmacists, because not many lenders that I see work with a lot of pharmacists. It's kind of these four subsets are a niche that we work with. So the program realistically is designed to, in my opinion, and I don't know if this is corporate compliance or whatever, but from the standpoint of, why are banks doing this? It's really helping to help a younger person, a newer doctor in particular, gain access to home ownership without having a huge hurdle of a large down payment, so that they can be part of a community that they want to live in. So we work with residents and the other demographics that are the career that we talked about. So that's what I do. I've been doing this for about 20 years. I've been working with doctors almost exclusively for about 10 years. Most of my clientele is doctor related, probably 85 to 90%. And then, friends and family of those individuals that just say, hey, you help me with this. Can you help my friend? So that's really how my business model has worked. And again, I've been doing this for about 20 plus years.
Awesome. I was a physician lender probably about 10 years ago. And so this is kind of something that's been near and dear to my heart for better part of a decade. So it's good to kind of hear somebody that's been in it a little longer than I have even. So so within every underwriting like every underwriter group, and there's some different things that kind of rear their heads as far as potential sticking points as it relates to underwriting these particular loans. They are different animals. They're a lot of times when a physician mortgage lender is battle tested, because they've gone through and found a lot of the headaches and issues that maybe don't pertain to some other types of loans. And so that's why it's really important to have somebody that's been working with doctors for so long. But what are some of those, I guess, hiccups that kind of come up within like off the top of your head? What sort of hiccups are something that you'd like physicians to know before applying, essentially? or at least be wary of that could come up?
Well, I think, even more important than some of the potential snags that can take place within a client's application is really what I find to be a lack of real understanding as far as how the mortgage industry works. And I find that most doctors, and consumers in general have a lot of unfounded perspectives of how things work. So what I try to do with a customer is when someone contacts me or have been referred to them, or however the client finds me and whatever, I try to start out with a very broad overview and just basically say, let's look at what I call the 5 components of how mortgage financing works. So I go through the 5 components and I try to, cut that down to, maybe a 5 or 10 minute conversation about, this is what you should expect when you're buying a home. This is what you should expect when you're understanding how mortgage banking works. And I don't necessarily want to give the whole roadmap because, quite frankly, people don't want to go through that whole exercise. And they may have heard some of the things, but you look at it and you go, what is income, assets, credit, collateral, compliance? How are all these things tied together with an application? And how does this process work? So I try to go through each of those bells and whistles so that they understand that the product set has various guidelines that have to be met. So our program, I think, is competitively positioned in the marketplace because we offer some features that many other companies don't offer. So one of those components is this. If you are a newer doctor, someone that's graduated from a residency program and you're taking a job, we don't have a reserve requirement. So no reserve requirement. And what that basically means, and many people don't even understand, what is a reserve?
Right.
So a reserve in the short version is, what is the monthly payment? So if you buy a house, the monthly payment's $5,000. Many companies will say, hey, you need 6 months worth of reserves that you're going to have just kind of on the sideline, you're not going to use, but you got to have access to it. So we don't have that requirement for our program, which is really important, and it can cause other people to have problems with some lenders when that's a requirement.
Right. So reserves, and just kind of say that in a different way, this is money that would not be needed for closing. So this is above and beyond down payment, closing costs, setting up escrows. This is money that would just, like you said, be sitting on the sidelines. And it equates to, for most lenders, they require, or for a lot of lenders, they require between 2 and 6 months worth of reserves. And there's different things that can kind of be applied towards reserves, like retirement accounts, a percentage of retirement accounts, checking, savings accounts, money market accounts. But that sticking point, especially for a new doctor, and in your case, I mean, obviously they're coming out of med school in a lot of cases, or at a residency and med school, with a lot of debt. They don't necessarily have a lot of assets, and so the fact that you guys do not require them to have reserves is huge. Now, how about if a doctor gets a new contract and that contract is dated in the future, so they're not actually starting till let's say 60 days out, can they close before then? And if so, would they be required to have a reserve of at least that first month's mortgage payment in their bank?
Yeah, so a typical contract, so we can use an employment contract that is signed by all parties stating what the position is, what the start date is, and that can actually be up to 90 days prior to the start with us.
Oh, wow. Okay, cool.
That gives some more flexibility. Now, from a billing perspective, we are going to require that you have enough money to make the mortgage payments until you start that job, because obviously that is going to make some sense.
Right.
But, that position allows people to be able to go out to shop for something today. And another nice feature about our program is this: we allow for gifts. So let's say, if there's a parent, family member that wants to provide the required amount of money for the transaction, as long as we can source that, prove that, we get them to sign a gift letter, then that money is eligible for the transaction to be approved.
Oh, cool.
Because some companies will say, hey, you got the borrower has to have 5% of their own money. That's a typical guideline. Ours doesn't do that. And then in different markets, so in today's marketplace, it's difficult to negotiate this, but I've had many deals where a buyer has bought a home and has negotiated the seller pay the closing costs. So if the home appraises for that value, that is an option. It can be done. In the current market, like I said, it's a little bit challenging to get that just because the competitive nature and listing agents are trying to push the price up as much as possible. But it is an option. So there's two features that are available for options for us to be able to help with the hurdle of cash to close.
Okay. No, that's critical to know, because I mean, truly, like if I mean, gifts, there's a good and a bad thing with gifts with a lot of different lenders, and the fact that you guys allow it to be not only considered, well, I mean, since you don't require reserves, that's huge. What about doctors that are starting, and I'll kind of move on to kind of employment contracts, and because we kind of grazed across that, but a lot of physician groups, they require, they're not technically employees, they're 1099 contractors. How do you guys handle, I guess, the 1099 contractor, self-employed physician?
So 1099 income and income in general really fits into the bucket that we call capacity. So capacity is part of the Dodd-Frank law passed in 2010, which really focuses on ATR, the ability to repay rule. So ability to repay basically shows that a borrower is limited to a debt to income ratio of 43%. So we take the gross monthly income multiplied by 43%, and all debts that are eligible on the credit report and the housing payment have to fall underneath that 43% debt to income ratio. So that's the calculation that we're trying to hit in order to understand the stability of the income, what the liabilities are. So there's a couple bells and whistles that we have to go through when we're evaluating someone's credit capacity from the liability perspective, and how we're handling student loans as a percentage of what that debt structure is for the capacity for the income side. So then when we roll to someone that has an employment contract, it's significantly easier when someone has a salary W-2 position, because then the math is fairly consistent and easy to calculate. When someone has 1099, moonlighting income, things like that, in order to have that be eligible, you have to have a 2-year history with the same employer. So what I find is problematic in the medical space can be emergency room physicians.
Right.
A lot of them take employment contracts where it's RVU based right from the beginning, or they may have a 90-day guarantee and then production and billing after that. And unfortunately, you're going to have 2 years worth of file federal tax returns in order to meet the continuity of income, the stability of income. And I find some veterinarians fall into that parameter, as well as a lot of dentists. So that 1099 income can be very challenging to work with. So that's really how it happens. And I would, for this exercise, if you've got some young doctors that are out there and they're listening to this, maybe they decide to negotiate a different contract saying, hey, I might be able to negotiate a higher per unit income. However, I'm going to have to wait 2 years before I can buy a house. So maybe I negotiate a smaller salary today, keep that job for a year, and then go into a production capacity, later on.
Right.
And that would be a prudent decision if they want to be a homeowner.
Gotcha. No, that's really it's really good to know, and kind of thank you for kind of breaking that up as far as like what the income requirements are, and certainly if anyone has any question about that, we're going to make sure that they have your contact information and everything. So how about especially for the newer doctors and those coming out of residency or even going into residency, how do you guys look at student loans, and how is that calculated as part of their debt to income ratio or?
Okay, so student loans are I don't know, not persistent. What's the word I'm looking for? Prevalent for many of the profiles that I look at. So the way that we do it, so let's say, for example, I have a medical school student person that's going to start a residency program. So what we do, which is a really important consideration, is we will take the student loans and we will zero them out.
Okay.
So I've got several doctors that may have several $100,000 worth of student loan debt, and then they sign a residency contract. So, and it has to be a residency contract, can't be a stipend. It has to be a residency contract. So we have to get a pay stub W-2 kind of information. That's how they're going to be paid. So education stipends can be problematic. It's important to know that distinction because some programs do it that way. And I would tell you that that can become a challenge. So let's say, for example, a medical student goes into a residency program, you're a PGY1. Let's say, for example, first year resident makes $50,000, but they have $200,000 in student loan debt. A lot of companies will take that $200,000 in student loan debt and they'll say, we're going to put a 1% payment factor in there in order to be eligible for the debt to income ratio for eligibility for ATR. So what we do is we zero it out because we know that that doctor is more than likely going to go into a pay system or one of the Fed student loan programs that'll be income-based repayment. So therefore, it'll be based on their income and their household size. And when those payments come in at that $50,000, $60,000, $70,000 income, more than likely their student loan payment will be zero. So that's a really nice competitive advantage. So some quote doctor companies try to do a doctor loan program and then they do it to Fannie Mae guidelines for that 1% payment factor. And it immediately makes the debt to income ratio beyond 43. So therefore they become ineligible.
Gotcha. Yeah. It seemed to be issues back in my day where I'd have to tell people to go in and go into income-based repayment so that I could get a payment for them. So the fact that you guys just kind of wave it all together makes it extremely beneficial.
And we do the same thing for someone that's ending their career, their residency program. Now they're going to go and they're going to be an attending as an example. Mm-hmm. So if they have their payments, what they're going to be for the next 12 months, once they complete their program, we'll use that payment. And typically that payment is going to be a little bit lower because the tax returns that were used to calculate the payment will be less than that 1% number anyway. So it's really helpful for that, resident that's going to say, hey, now I've, got my first contract and I'm making 100, 200,000, even with that income, if you've got a tremendous amount of student loans, that can still be problematic for buying the home. Gotcha.
I think that really does hopefully kind of crystallize how the student loans will affect them, especially with you guys. Let's see. I think that kind of goes through all my questions. Did you have anything else that you wanted to add to it, or is there any other scenarios that kind of pop up that you'd like to discuss, or what's,
I think one of the benefits for our program is we're keeping the loan on the book. So there's no mortgage insurance, there's no prepayment penalty. And what I like to talk about with doctors is, let's say you're going to buy a home and you work towards paying off your student loans. I always feel like that's the most prudent path because at the end of the day, student loans are really a consumption item from debt, and it doesn't really help with the wealth appreciation process. So if you have a mortgage on a house, the house will go up and down in value regardless if there's a mortgage on it or not. So if you have your other debts cleared off and you've managed your cash flow, you're helping create a better wealth appreciation for yourself and your family. So one of the things that we do that's nice, because we're going to inventory the loan, we're going to keep it on the books, and because there's no prepayment penalty, we allow for what's called recasting. So recasting, I almost describe this as a deferred down payment benefit. So let's say, for example, a physician buys a home and they do $1 million house. So my program, I can do 100% financing up to $1 million. And that's a pretty substantial.
Let's stop there. Yeah. 1 million. I guess we didn't really dive into that at all, but you can go up to $1 million without any down payment.
Correct.
Okay.
So my loan program works like this. We can do 100% financing up to $1 million. We can do 5% down for a loan from 1 million to 1.5 million. Then we can do 10% from a loan from 1.5 million to 2 million. Or I'm sorry, 10%. 10% from 1.5 to 2 million.
Yeah, I'm picking up what you're putting down.
So that's important because let's say, for example,
that's probably, I mean, if somebody's looking in the upper like 750 to 900 to $1 million. Like, there's just not a lot of people that are offering that. And then up to $1 million, 1.5 generally is at least 10% down. So those are some very, very aggressive LTVs that you guys offer.
Yeah, I think we're one of the more aggressive firms with that. So when you kind of couple that with, we don't have a reserve requirement,
Right.
It really changes the dynamic of what we're looking for, because we'd like to believe, and I think this is the firm's position, that, people that are buying homes in this price range have the income to support it.
Right.
And these are intelligent individuals that know that they have the obligations, and we go through the math and they know what they're getting into. And at the end of the day, if we look at it and we say, all right, let's talk about the recasting again. So let's say somebody buys a home for $1 million, and then a year later they have $100,000 that they want to apply towards the mortgage. Or maybe it's a couple years later. So what happens is maybe they've paid off their student loan debt and they're sitting there just with a mortgage, and they're saying, okay, I want to take this $100,000 and I want to apply it to my mortgage. We can take that money, apply it directly to principal. And then what happens is the payment going forward will be based on that new lower loan amount.
That's cool.
So what I try to talk about
the same. Yeah, the term stays. So it's not a refinance. The term stays.
Not a refinance.
There's 25 years left, and they decide that they want to plink $200,000 towards their mortgage amount and have their payment reflect that. That's really cool.
It's really huge, because there are many doctors out there right now. And here's a great example. Let's say they were a resident and they bought a small home. Right. Now they're going to buy another home, and maybe the math doesn't quite work out where they don't have enough money right now, but their income has gone up, but they're carrying both loans. So we would say, go buy the new home, write an offer that's non-contingent on the sale of your current home. Once that home sells, if there's equity, you can apply that towards the mortgage here, or take that money and apply it towards other debts to manage your cash flow in a more effective manner. So I describe this as like a deferred down payment benefit.
Yeah.
So we have a small fee that we charge to do it. It's $250 every time they do it, but they can do it many times. And as a competitive analysis, I would tell you, other companies that do doctor loans that have this feature typically let you do it once or with 10% of the outstanding balance. So if you have $1 million house, you can do it with 10%. You have to do it with 100,000. That may become limiting. We could do it with as low as 10,000. So that deferred down payment is really important for helping manage cash flow and getting a lower monthly payment as time goes on. And that, I just think that feature alone sets us head and shoulders above many other companies.
Yeah, that's really cool. That's, essentially they don't have to refinance ever, like, especially and we won't get into rates because that's going to change, but especially at the time of this recording, the rates all across the board are pretty low. So, well, that's really cool. So I think that kind of concludes kind of what we wanted to pull out of you today, Jim. So thank you for coming on, and thanks for kind of shedding some light on your loan and kind of how it works. And I'm certain that a lot of doctors out there will find value in this. And if you're watching this, I'm going to include a link in the description that will give you the ability to get a hold of Jim directly. So just go ahead and click the link below, and we'll get you in contact with Jim. So thank you, everyone. Thank you, Jim. Thanks for coming on, and we'll see you on the interweb.
Appreciate it. Bye.
All right. Thank you.